Thank you. And thank you for the opportunity to discuss how to maximize your divestiture dollars. So Alex and Michael and Ray have talked to you about how to grow your company. Now I'm going to talk about how to get the most dollars out of it when you sell it, assuming that's the route you want to go. But what we're seeing these days in the technology space, that's what a lot of our tech startups are doing. So a little bit of background. In the last 24 months, I've had 3 material divestitures that I've worked on. One with Dan, the social deck. Google bought social deck almost, I guess, 18 months ago now, closing in on that. Then I guess this building's a lucky one because the same building 5 Mobile was located in, and Zynga bought them out about a year later. So I was fortunate enough to meet some of the people there, and they got us involved as well. And lastly, I got a deal that's happening with Ceridian right now. It hasn't closed yet, but that should be closing very shortly. It's probably the worst kept secret, so enough said there. So there's some of the background. And I guess the theme that I want to get at is when you're planning for divestiture, don't wait till you got the letter of intent on your desk. You got to do it early, because unfortunately, actually, in Dan's case and in the 5 Mobile case, unfortunately, I met those guys about 6 months before the deal happened. So we were probably just gearing up to start planning for the divestiture. All of a sudden, boom, the LOI's on their desk. So I'll touch a bit on that as to what, if you start planning 2-3 years ahead of time, then you can really maximize your dollars. How does this work here? Oh, we're still thinking though. Okay, here's the agenda. So the first thing I'm going to talk about is exemption. I'll talk about that in future slides, but it's a $750,000 exemption you get on the sale of certain shares. Then I'll talk about how you multiply it. There's some planning tools around that. So again, you're going to get more dollars when you sell. I'll try and keep the third point brief. That's the boring tax rules on how you qualify for it. Some traps and pitfalls, and then just some other miscellaneous things about divestitures at the end. So as I said, for the lifetime capital gains exemption, what is it? It's a $750,000 exemption that finance has granted us. It's been there, I don't know, it's probably about 20 years now, maybe even longer. That you can get if you sell the shares of your business. Now, what does that crunch out to? It's a $750K deduction. So, assuming you're at the highest tax rate of 23.2% on a capital gain, you're saving $174,000. That's what's going in your jeans. So that's really the takeaway from that. And then there's some certain restrictions and criteria. I'll get into that in a bit. But this is a share sale. So it's you're selling your shares, not the assets in your corporation, the shares. And that's why in a lot of cases, most startups want to sell the shares. They don't want to sell the goodwill or the assets of the business. They want to sell the shares. So we'll get into multiplying. So here's the standard way to multiply the exemption. I'll just give you the standard example. Let's say you got a company today, it's worth $1 million, $1 million company. You think you're going to sell in 3 years. So you decide, you know what, I like this idea, I want to do it. How do I do it? So what you do is you freeze the value. What does that mean? All it means is, right now I got common shares worth $1 million. I turn those into preferred shares worth $1 million, so the value is frozen in those prefs. And now I'm going to take back commons worth $1. So now those commons are really cheap, they're easy to move around. So what do? I set up a family trust. And what does the family trust contain? Well, what's going to be the characteristics of the family trust? I'm going to have beneficiaries of the trust. They're going to be my spouse. They're going to be my kids. They're going to be perhaps my mother and father, because in a lot of cases, the startup entities we deal with, some of these guys are right out of university. They're 23 years old, 24-year-olds. They're not married yet. So what do? They put their parents in. And what happens is 3 years from the date you set up that trust, let's say the company's now worth $4 million, so a $3 million incremental amount. Let's say you got 4 beneficiaries in the trust. If I've done my math right, 750 times 4, $3 million. I'm paying no tax. So if you structure it correctly, you're saving $174,000 times the 4 people you added on, plus the original $174,000 that you had. So that's a nice little savings. How difficult is the trust to set up? It's not that hard. I got a lawyer that sits 2 floors above me in our North York office. I use them all the time. I bring in clients, we set it up. You know, it depends whether you want the Chevette or the Cadillac trust. You can really make it quite elaborate because that money is going to go to your kids or your wife or your spouse. So you may want to put in specific rules, or you might want to keep it really simple. But that's the crux of the idea. There are some other things you can do, but this is the most common way you can multiply the exemption. Now we get to some of the, so this is the tax type rules that we have to get through to qualify. So the term that's used for a share that's sold that qualifies for the 750 exemption is called the Qualified Small Business Corporation share. So first of all, it's got to be a small business corporation. I'm going to get to that in the next slide. But there's two other tests that have got to be met. One's here, and one's here. The first test is you got to hold the shares for 24 months, either you or someone you're related to. So that's generally not a problem. But every once in a while, and I've seen this with some of my deals lately, they sell so quickly after the startup, you're borderline not holding it 24 months. So keep an eye on that. You only can take advantage of this. I do have some mechanisms. There are some ways to get around that. But generally speaking, you got to hold it 24 months. That's the simple way out. Most of the time, that's not a problem. You can run into an issue also. I had one client who transferred to his wife. Well, he transferred to his wife 12 months before the deal. Unfortunately, you're not related to your wife until you're married to her, so they weren't related for 24 months. Luckily, we did some digging and we determined they were common law, so we found a way around it, but keep an eye on that too. If you're transferring, there is a 24-month hold period. Like I said, generally not a big issue, but something to just keep an eye on. The other test, the other 24-month test, is the assets have got to be used in an active business. What's that mean? That means you're not holding a real estate property in there that's worth 60% of the business, and then you're going to try and sell the shares and claim the exemption. That's not going to work. It's got to be active business assets. So goodwill's probably in the tech space. The biggest asset's goodwill. You've developed some IP, maybe you got some patents, and that's the bulk of your value. Generally, with a startup, this probably isn't a problem. I'm guessing you guys aren't sitting on a mountain of cash and you're not buying Johnson & Johnson shares and letting it sit there. This is more of an issue down the road. Maybe you're 5 years down the road. Hopefully you've made lots of profits and you're starting to invest it. So if that's starting to happen, that's where you want to get like a tax advisor in there, and there's certain things you want to do, like pull the bad assets out, maybe pay a dividend, move it to another corporation, that kind of thing. Small business corporation, that was the other definition I was going to get into. In order for the shares to be those special type of shares, qualified small business corporation shares, it's got to be a small business corporation. Well, what does that mean? Well, that's a test that you have to look at when you're selling. So that date when you sell, that's when you got to meet it. It's not a 2-year look back, it's the date of the sale. Now, it's a higher threshold though. You need 90%. So if I got 20% that's in Johnson & Johnson shares because I really wanted to invest in them and I had some spare cash, I got a problem. But it's easy to fix. You generally will have a lot of leeway before you sign the dotted line on the purchase and sale agreement. So if you got a good advisor, he'll tell you, you know what, you got to pull out those assets, pay a dividend, you know, and just pay it out or repay a loan or something. Somehow get that asset out before you sign the purchase and sale agreement. That's called purifying the company. You've purified it to meet the test. Not that difficult, but again, keep an eye on it, because if you've already sold, if you signed it and then you go to your tax advisor and say, hey, I sold this company, I get the 750, and then you know, you might have to deliver bad news, so you might look at the balance sheet and say, hey, wait a sec, what's all these assets here? That's not really a core asset. What is that? Again, as a startup, probably not an issue, but down the road, keep an eye on it. One of the other criteria to think about, you probably won't see this a lot in the space, but you could have a holdco-opco structure. So you know, the holding company, maybe you got family members that are participating in profits, dividends, etc., and then you have the core operation down below. Of course, finance has to make life difficult. They make the test more complicated if you have stacked corporations. One of them's got to meet a 90% test over the 24 months. So the simple advice is keep the holdco simple. Don't put anything in it other than shares of the opco. Don't be doing portfolio investments in there, stuff like that. Let it meet the 90% test, because that should be easy. And then the opco probably is meeting the 50% test without any problem. It's running, that's what it's doing. It's running an active business, so it should be fine. So again, just keep an eye on that, you know, if you've got some of these bad assets like investments, that type of stuff. Some of the other traps and pitfalls, we love acronyms. So senile, that's the cumulative net investment loss. These are all things that have adverse effects on your capital gains exemption. So the senile, if you've invested in tax shelters, or if you've got a property, a real estate property that's lost money, to the extent you've got losses, that grinds your capital gains exemption. So if you lost $100,000, you've claimed that on your personal tax return. Unfortunately, what that means is it's going to grind the capital gains exemption. So something to keep an eye on. A-bill similarly grinds that. If you've got that special type of corporation, a small business corporation, so let's say you invested in one of those, you had another startup 3 years ago, you put $100,000 into it, unfortunately it didn't work out, so you claim this special kind of loss. That loss is a capital loss, so it's only 50% deductible, but it's deductible against anything. So you can deduct it against salary, other profits. If you've claimed one of those, it grinds your capital gains exemption, so just keep an eye on that. You might have that if you've invested in multiple places. Alternative minimum tax, again, lovely finance decided that in certain situations we're going to hit you with a minimum tax. And one of those is, actually I just ran off a dummy return this morning. If you have a $750,000 gain, you happen to sell the business for $750,000, the whole thing's exempt. Unfortunately, if you've got no other source of income, you're going to end up paying $40,000 of alternative minimum tax. Now, it's still a hell of a lot better than $174,000. The other saving grace is the alternative minimum tax is fully refundable in the future as long as you make income in the next 7 years, salary, dividends, other sources of income, you can get that money back. It's a refundable tax. So it's a pain because you're going to have to pay it at the time, but it is refundable. Losing CCPC status, Alex and Michael spoke a little bit about that before. Again, the key things you see all the time are a VC coming in. Sequoia comes in from Silicon Valley. They're a foreign investor. If they have some type of right to acquire more than 50%, all of a sudden you've lost your CCPC status. That means you've lost your capital gains exemption. So you could have a problem there. So if you've got a big round of financing, make sure you understand how that's affecting your cap table. And there are things you can do to plan around that. For example, we had a similar situation. We had a VC come in. So we knew we were going to lose CCPC status in a couple months. And we had a whole laundry list of shareholders that wanted to utilize their capital gains exemption. No problem, you can do it. You just have to trigger an internal sale. Sell to your sister, sell to a holdco. Just trigger that, and then you can utilize your gains exemption, and you've bumped up your cost from probably nominal $100 to $750 or the multiple of $750. And that way, when you actually sell for, say, cash 3 years from then, you're only going to pay the tax on above $750. So again, that's where the communication's key. You got to know what's going on. It's hard to do that after the fact. It's really difficult. So if you know what's coming, not so bad. But if it's after the fact, very difficult. The other thing that can happen with CCPC, and you do see it now and then, because in the tech space, a lot of founders, employees end up moving to Silicon Valley or somewhere else in the US. Well, when that happens, you're not Canadian anymore. So if that's a founder and he's a significant shareholder, just by moving down there, you may have just lost CCPC. So be careful of that, because you get tempted. You got a lot of business down there, a lot of tech companies, your biggest buyers in the US, so you want to get down there. So again, know that going in, plan around it. Some other traps. Attribution rules, all that is, again, I'll give you a simple example. Every once in a while I have a client come in and say, I got a deal that's going to happen. I'm going to sell half my shares to my spouse. I understand I can do that at cost, so I'll sell it to $100, and then she'll get the gain, and that way I'll double the exemption, because let's say you're selling for $1.5 million. Problem with that is if it's not a fair market value transaction, the gain attributes, hence the rule, attributes back to, I'll use the example husband-wife, so it attributes back to the husband. So that doesn't work, and that's what those rules are there for, so you can't transfer it the day before. But that's why the trust works. The trust you want to do early on, while you have low value, because again, this is the theme, you want to do this early, plan early. Because if you're only worth, 500,000, a million now, and you think you're going to be worth 5, 10, if you do it at this point, that growth can be used in your trust and allocated to the beneficiaries at the time of sale. So the key is plan it. We talked a little bit about U.S. resident. We talked about the bad side of it, and that is that you could lose CCPC status. There's actually a good side. And what that can be is when you leave Canada, you're deemed to sell everything. So let's say your shares are worth $1 million when you leave Canada. Okay, you're going to take a little bit of hit. You're going to pay 23% on that, assuming you're at the high rate of tax. You're going to pay $230,000. But let's say you're really confident with your company. You know this thing's going to go gangbusters. It's going to be worth $30 million in 3 years, and you're really confident. Well, that game's locked in, so that money's out the door. I can't do anything about that. But what I can do is if you go to the U.S. and you become a resident there, so you do it right, you buy a house there, you sell everything here, you become a resident of the U.S., there's a mechanism that will, you won't have any capital gains tax on the gain since when you left. So I think I used to $1 million to 30. That $29 million, theoretically, you can get exempted on that. Got to meet the right facts, paperwork, that kind of stuff. You want to make it clear. You've left residency of Canada. You've become a resident of the U.S. You're going to have to leave the U.S. before you actually sell the shares, and I believe you have to do it within 5 years. So the reason being is the U.S. generally won't tax you because you haven't been there long enough on that gain. And again, it's pretty technical, but if you're finding that you have to move to the U.S. anyway, or you think you're sitting on a gold mine and you think your company's going to go crazy on you, then that's something to think about. We happen to actually just run into that by chance with one client.
Can I ask a question?
Sure.
So when you say leave the U.S. before you sell, meaning come back to Canada?
You actually have a couple alternatives. You just have to leave the U.S. You don't have to come back to Canada. You could go to Barbados, wherever you want. Most people would want to come back to Canada. That's usually what we've seen. Not that I've seen it that many times. We've seen it a half dozen, but most want to come back to Canada. Yeah. That works though. Again, it's complicated. It's something you want to get a specialist involved in because you're talking cross-border issues and detailed residency issues, but it's doable. And this is the last slide, so I may as well finish off. Other exit points. This is just bookkeeping type stuff. We had one deal, a partner of mine down the hall. The bookkeeping was an absolute disaster. Our audit guys, it was really big dollars. I think it was in like a range, a couple $100 million deal. So they had subs everywhere, all sorts of countries, this kind of stuff. And their bookkeeping was a nightmare. My fellow partner estimates they lost about 20 cents on the dollar because the buyer just didn't want to take on the risk. And that's the negotiation you're going to get into. If they're not comfortable, they're going to be trying to push holes into your entity. Risk here, risk there, and they're going to try and drop the price on you. So try and keep those books and records up to date. Early on, it's not as big a deal. I know you're always going to have the juggling of where am I going to spend my money when I'm early phase. Am I going to spend it on a patent, or am I going to make sure my books and records are up to date? So you have to make that call. But as you grow, you're going to have to consider these kind of things. Keep the tax filings up to date. If you're filing shred with my buddy Alex or Michael or me, because that's another hat I wear, you're going to want to file on time anyway because you get your money back faster. So that's generally not a problem in the tax space. But keep those records up to date. Just as an aside too, in the due diligences that I've seen, the two most common problems you see raised by the buyer, so when he's trying to reduce your price, are sales to the US. That's missed a lot, that you've got a tax filing requirement there because you've got a big enough presence in the US. Or sales tax requirements in the US because you've got a salesperson running around in various states. The US loves to tax you on that. They have lots of big deficits in many states. So California loves to reach out to people sending software down there and that type of thing. I believe now they even have a $500,000 minimum or a threshold. If you have sales over $500,000, you're required to register down there, and I believe you even have to file a state return. So that's one thing that you see a lot. The other one is the old standby, contractor versus employee. I'm sure you probably have lots of like as the business grows, you're going to have lots of contractors. There's always the issue of, well, is that person really an employee? And if he's an employee, why didn't you source withhold? And you know what? I'm reducing my price by 50 grand because I don't think you did it right. So then you want your guy to stand up and say, oh, no, 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 wait a second, it's fine, here's why, here's the rules. So that's the kind of things you see in negotiation. Last couple points, I've talked a lot about share deals. So in most cases, because of the 750 exemption, the seller generally wants to sell his shares. The buyer generally wants to buy the assets because when he buys the assets, he can deduct the stepped up value. When he buys the shares, there's no real deduction. So there's a bit of a negotiation there. So generally speaking, small owner manager deal, you usually end up with a share deal. But once you get to a bigger dollar number, you might want to start looking at, am I better off selling the assets? If you've got significant startup losses, when you do the number crunching, you actually might be better. If you've got a lot of foreign VCs, there's some tax attributes that I can carve to the Canadians that the US guys don't care about. So I can actually, in some cases, get you more after-tax dollars by selling the assets of the underlying corp instead of the shares itself. So sell the goodwill, sell your customer list, all that kind of stuff. So that's a number crunch. It's literally a big spreadsheet. Depending on how big the company is, that depends on how big the spreadsheet is. For that one deal that was a disaster, you should have seen the analysis. It was massive. But in smaller entities, you're looking at relatively simple calcs. And there's some other really specific divestiture solutions that I have to defer tax if you have a share of assets and that type of thing. They're a lot more complicated, and in smaller deals, it's probably not worth even going into. But 50 million, 100 million, if you're selling at that level, then these other technical ways of selling can be worthwhile. Right, that's about it.